Owning a single company stock can be fun, especially when it's going up in value. Even then, it is time to spread out your risk to other investments because a stock can go down as well as up. After completing this video, you should know the importance of diversification, as well as be able to address whether to consult a financial planner or not. In addition, you should have a basic understanding of how to research investments online and with financial publications. Before beginning, please take some time to look over the key vocabulary for this lesson. These terms will be used throughout the unit and weekly assignments. To diversify your investments, follow these important steps. Assess your own risk, tolerance, and financial awareness. Learn about investment opportunities of which you can take advantage. Figure out how long you have to invest before you will need your money, and use financial modeling software to buy stocks and bonds and watch what happens before it's your own hard-earned cash on the line. You will soon learn the power of diversification for long-term growth. So what is an investment portfolio? An investment portfolio is the collection of investments you personally hold, including stocks, bonds, money market accounts, and savings accounts. If you are like most teens, your investment portfolio consists of a savings account at a bank and some U.S. savings bonds given to you by your family members when you were younger. Not a lot of money to manage. So why start worrying about diversification now? Soon enough, if it hasn't already happened, you'll get a job that gives you the option of putting some money away for retirement. Retirement may seem like a long way off, but think of today as a golden opportunity to start building wealth for yourself. In any case, get an idea right now about how to invest in a diversified portfolio. Knowing how will help for you to come in handy when you have a bunch of investment options to choose from and you have to make a decision. So what is diversification? Diversification is owning a collection of investments such as stocks from different industries in small and large companies, bonds, and money market funds for cash, in order to spread risk and have a safer investment overall. Let's say your aunt gave you 100 shares of IBM stock when you were born. Do you still have 100 shares? Actually, the stock split 2 for 1, or gave every investor 2 shares for every 1 share he or she owned. It split 2 times in the past 10 years. The original 100 shares became 200 shares, and then it became 400 shares. Now that nice little nest egg is worth over $45,000. But over the past 10 years, the 100 shares has been worth as little as $5,000 and as much as $52,000. The difference is a lot of variety. Think about it. What if you had a bank account in which you were saving money, and depending on what day you went in, you could have 1/10 of that amount that you used to be there? That situation is where diversification comes in. By selling some of your IBM shares and purchasing a mutual fund that gives you a greater spread of risk, you can keep your exposure to the upside of the market while limiting the downside. Diversification will help you weather the more challenging bear markets. A bear market is time when stocks seem to stay at about the same level or lose ground. During a bear market, bonds and interest-bearing investments are very attractive compared to the stock market. By diversifying from the start, you will already have a balance of bonds or bond funds, stocks, and a money market fund. Diversification will also help you weather bull markets. A bull market is a time when everyone seems to be buying up stocks and stock prices seem to keep going upward. By having a diversified group of investments, you'll be able to take advantage of a bull market. If you have money to invest, it may be worth your while to speak to a financial planner. These investment advisors can be helpful in letting you define and reach your financial goals. Financial planners must file a business form called the Form ADV that you can request to learn about their rates, business services, and strategies. Be aware that some financial planners work for a specific group of investments, and it is their job to convince clients to invest in those funds. For example, a bank can have an investment advisor at the bank branch. That investment advisor may advise everyone to invest in a portfolio of mutual funds that are managed by the bank itself. This advice may be good in a diversified portfolio, but the investment advisor is working for his or her employer, not for you. Financial planners who are brokers will generally not charge you for planning. However, they may not do much planning beyond telling you what would be a good idea to buy today for a balanced portfolio. Financial planners who will plan your investments for you may charge a percentage of the amount you have to invest or a flat hourly rate. Whether it's the Wall Street Journal, Investors Business Daily, or some other financial newspaper, you should regularly read daily business news. You will quickly learn about the financial problems one region may be facing and the opportunities that another investors are finding. You can learn a lot from a Business Weekly magazine, such as information about up-and-coming industries, investment strategies, and even tips on tax strategies for the investor. The internet is a great place to find financial information. For example, if you want to keep track of 5 mutual funds you are thinking about owning sometime in the future, you can set that up at such sites as finance.yahoo.com. You can also use those sites to look up what a stock was worth on a certain date. This data can be important in researching how such a certain stock has been worth over time. We have now completed the video. Once you've completed the entire lesson in video, you should be able to understand the benefits of a diversification as well as the importance of an investment portfolio.